Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome back to the DIY Wealth Canada podcast. I'm Bob here. Alongside with me is my co-host Nelson. Today we got an exciting episode. We're going to talk about overcomplicating ETF portfolios. So this one is quite interesting for me because the other day I actually read that there are way more ETFs in the market than the number of stocks, which kind of boggles my mind. And that's why we want to talk about this. Nelson, what's your thought on overcomplicating ETF portfolios? Like there's so many out there, like how do you pick one over the other when they're so similar?
Yeah, that's the problem that comes up. And I think this is an even bigger problem because at the end of the day, ETFs were created for a couple of reasons. One, of course, you keep fees low, and the passive nature of a lot of ETFs contributes to keeping these fees low. You don't have to rebalance the portfolio very often, so therefore it just sort of continues to compound behind the scenes, and you don't have a lot of fees attached with that, which is a very good thing for the average investor. But the other reason why ETFs were created, at least from my perspective, is the simplicity behind it. It's just this very simple way to get exposure to whether it's the S&P 500, whether it's a TSX composite, or whatever sort of index you want. That's the whole point, is to create this simple way to follow this index. And the problem is that the ETF providers have taken this simple concept and said, hey, if it's a good thing that investors get a simple way to invest in the market, let's take this to the next level and let's give investors a simple way to invest in any sort of almost thousands of different strategies that are just slightly different than the next strategy. And the problem, of course, when you get so many options, like you said, there are now more ETFs than there are underlying stocks, is that you create this complicated system of which ETF should I choose? How can I choose a good ETF that helps me hit my investing goals? And with so many out there, it just has become more and more complicated, which is sort of in their zeal to create more has really kind of tampered with the original reason why ETFs were so powerful in the first place. And I think this is a massive problem for a lot of investors who just want something simple. There's just too much choice out there.
Yeah, I mean, just look at the all-in-one ETFs, right? Like there's so many of them. Like Vanguard has a few, iShares has a few, I think Horizon, and there's so many. Even like TD has some too, and I think BMO has some as well. And then we're just talking about the all-in-one. Now you get into the dividend ETFs. There's so many different combinations of dividend ETFs as well, and it's quite overwhelming. And really, ETFs are all about simplicity and being able to just pick one and stick with them. But now there's so many choices out there. It's getting tough and tougher to stay with one. And how do you know which one is better than over the other? And there's so many minuscule differences between all these different ETFs. It's just getting harder and harder to pick. And it's almost down to the point where maybe it's easier for some of these index ETFs, just create your own rather than rely on these ETFs because they're getting so complicated.
Yeah, for sure. I want to tell a story about, I read this on Reddit. It's months ago now. I don't know how long ago it was, but the point is the story is really telling with how this sort of impacts investor behavior. And the story is the guy who posted this on Reddit, and I'm assuming that this is genuine. People like to troll on Reddit sometimes, but I'm assuming this is genuine, is he says, I've invested in VOO, which is the Vanguard S&P 500 ETF. I want to change it to the SPY. And he says, I want to do it because I'm going to save something like 0.05% per year in management fees. And it revealed in the comments that this guy was doing so, but he would have to pay a whole bunch of taxes in order to do that, because he would have deemed to have sold, or he wouldn't have deemed to have sold, he would have sold one ETF and bought the identical ETF, sort of moments later. And this guy got to the point where he's creating this tax obligation, this tax bill, in order to save just a few basis points every year in fees. And that's the danger that I really worry about with this stuff, is that it just encourages overcomplication, because it's just, there's so many choices out there. There's so much out there that people get a little bit overwhelmed, and they sort of do things that don't make any sense just to, like this guy in this Reddit post, just save a little bit of money. It's, you have this situation that really almost begs investors to do something, because in most other aspects of our lives, doing something is good. Being active, being proactive is good. But in terms of passive investing, you don't want to do anything. You just kind of want to let compounding do its thing. And how complicated this world has become has created a situation where, like I said earlier, you have a very simple solution that has become more and more complicated because there's just too much choice out there. It's like going to the grocery store and you're looking at the jam section. There's 27 different kinds of jam. I used to work in the grocery business. I know that there's like 27 different kinds of jam, and it gets overwhelming when all you want is just jam,
Yeah, and you hit the nail right there in terms of people going from one ETF to another ETF just to save like 0.05% in terms of fees. And if you're switching between ETFs in your taxable account, like non-tax deferred account or tax advantage account, meaning RSP or TFSA, yeah, there's no tax implication. Now, when you start doing this kind of maneuver in taxable account, you have to pay taxes, and most likely you have some sizable tax capital gain. And just to make it clear, like if you have a $1 million portfolio, like a 0.05% difference is $500 for the whole year. End of the day, when you have a $1 million portfolio, $500 difference is probably not going to keep you up at night. So I really caution people overcomplicating things, as you start chasing ETFs that have the lowest possible fee, because these companies are always restructuring their ETFs, and things change, and the management fee tend to go lower and lower, especially with these passive index ETFs. So switching back and forth just simply doesn't make sense. Now, we have done that in the past, where we went from VXC to XAW many years ago for our ex-Canada portion of our portfolio. And that was to save, I think back then was like 0.5% or 1% of MER difference. And for us, we ended up going from VXC to XAW simply because XAW had a little bit higher exposure in the US. So we thought that was worth it. But would I switch to VXC if VXC was a little bit lower than XAW nowadays? Probably not, because now we would be realizing a lot of capital gain, and we have to pay taxes, and that's just something we don't want to do at this point.
Yeah, I think too, when you talk about the switching part of it, you create this danger of switching out of a fund that might not be performing at the moment. And we look at the S&P 500. The S&P 500 has marched higher basically for 15 straight years. It stumbled a bit in 2018 and 2022, but for the most part, it's just been up and to the right. And I think I want to caution people in just saying that, like, look, this is not a normal activity for the S&P 500, for the market overall. We generally stumble more, and you look back at the kind of 2000 to 2010, 2011 decade, and the S&P 500 didn't go up at all during that decade. So what happens when the underlying index doesn't cooperate, doesn't do what we want it to do, is people get impatient and they sell. And that part of it is, you talked about how you made a switch, and you made a switch because you wanted more ex-Canadian exposure, which is a long-term plan that you thought out, and you made a good change there. But if someone's selling an ETF because, hey, it isn't performing, it isn't going up, whatever, that's always a danger in the fact that, like, we don't want to sell something just because it hasn't worked out over the short term. We don't want to chase a sexy new asset class just because it's performing well now. We want to make solid financial decisions that will work over decades. And this whole switching mentality, I'm afraid, takes away from that for the average investor. And that always concerns me a little bit.
Yeah, for sure. Now, let's talk a little bit more specifically some of the names that we come across and how maybe we could help listeners to pick or narrow down the choices. The one I really want to talk about are these all-in-one ETFs, in particular the all equity ETFs. Right, so there's like VEQT from Vanguard, XEQT from iShares, HEQT from Horizons, and ZEQT, I think that's from BMO. And there's also, I think TD has similar thing as well. I forgot the symbol for them, but they're so very similar, Nelson. Like, how would you pick one over the other? Like, what are your thoughts on that?
That is a great question. And it really comes down to sort of the meat of this argument, is that it's very hard for somebody to take a look at each of those ETFs and say, okay, which one is best for me? Now, the good news with those ones is my understanding of them. I haven't looked at them super closely because I'm not a big investor in any of them. Not that they're bad. It's just that's my choice is to build a active portfolio on my own and avoid ETFs. So saying that, I think that it all comes down to working backwards from your plan. And of course, if your plan is just you want a decent all-in-one ETF at a reasonable fee so you can get exposure to the entire world of stocks, then I think pretty much all of those ETFs are a decent choice. The differences between them are not going to matter that much in the scheme of things. One might have a little bit extra American exposure. One might have a little bit of extra Canadian exposure. One might look at the rest of the world. But at the end of the day, they're very small tweaks that really shouldn't matter in the scheme of things. The scheme of things is picking one, sticking to it, and just making sure that you don't do anything stupid like switching out and giving yourself a big tax bill. Bob, do you know the differences between these ETFs maybe a little better than I do, so you can maybe talk about each one a little bit further, or would your kind of message be the same as my message?
Sure. I actually wrote a blog post a while ago comparing these OE1 ETFs, right? So I actually compared TD versus BMO versus iShares versus Vanguard and trying to figure out which ones are better over the other, right? So I actually looked at the different ones, like the conservative ones, the balanced one, the growth, the all equities. Now, if we talk about the all equity ones, so like the EQT ETFs, right? So there's XEQT, VEQT, ZEQT, XEQT, and then I just realized the TD ones are TEQT. So you can see how it gets very confusing, but they're all very, very similar, right? Their MERs are somewhere between 0.15% to 0.24%. They're within 0.05% of each other, or less, or a little bit, just a fraction, a little bit, depends. And they have the tendency to lower their MER over time. And some of them have longer starting point than others, right? So for example, TD just started their TEQT recently, whereas both Vanguard and iShares have these ETFs for, I think, over 5 years now. And ZEQT, the BMO one, I think it's less than 5 years. And if you look at the returns, since they track the entire market, they're all very, very, very similar. So it's really you pick one over the, like you just kind of, you could essentially throw a dart to the board and just pick one, right? So I don't know, for us, we like either Vanguard or iShares, so we just kind of pick one over the other. And again, we picked XEQT for our kids, our ESPs, simply because XEQT, when we looked at that, when compared to VQT a number of years ago, XEQT had a little bit higher exposure in the US market than VQT. And knowing the S&P 500 tend to return a little bit higher than the TSX, we decided that XEQT might be the better choice of the two between XEQT and VQT. But in terms of performance, I mean, they kind of sometimes, like 1 year one would do better than the other, and then vice versa. So you kind of just stick with one and don't chase the lowest MER, in my opinion. Now, the other thing to consider, and unless you own a lot of shares, maybe it's not too big a deal, is when you start to sell, you want to look at the volume, the trading volume, because if you end up trying to sell, a few thousand shares at a time or even more, if the ETF has low trading volume, you may not be able to sell all your shares. Right? So you can imagine if you're holding an ETF for your RESP, and when your kids are going to university and you want to start selling and holding things in cash, if you can't sell all your ETFs, that becomes an issue. So that's something you may want to consider. Now, if you're investing in, the Vanguard or the iShares, that's not a concern at all. But I don't know what the trading volume is for the TD one, for example. I think it's a lot lower than the Vanguard and XEQT. But yeah, I think, Nelson, I'm kind of in the same boat as you. Just kind of pick one that you're familiar with and stick with it. Don't jump around.
Yeah, I think too, the figuring out your risk tolerance, figuring out kind of that what you want out of an ETF is by far the most important thing. We have to consider all sorts of things. We have to consider whether we want a more aggressive equity portfolio. We want something maybe a little bit more boring, like a dividend portfolio, or maybe you just want to retire on dividends, which is another thing that, like I said before, working backwards from your goals are important. Just realizing that, more ETFs don't necessarily make you more diversified if you're buying the same sorts of asset classes over and over. And B, consider mixing in some fixed income, whether it's one of the balanced ETFs. We're talking a lot about these all equity ETFs, but you can buy ETFs that have a 70-30, 60-40 stock versus bond allocation, and you can get all that in one simple package. So I think it's really up to everyone listening whether how complicated they want to make it. But I would urge everybody, like you said, Bob, just keep it simple, figure out what you want, and then go from there rather than trying to, switch up, keep it simple, etc. So maybe what are some of the things that, if someone's looking for maybe more of a balanced portfolio, would you go with one of the ETFs that already has that built in, or would you kind of go for a more two-fund solution? How would you go about that if you were building something like that for one of our listeners?
Yeah, so going back many years ago when these all-in-one ETFs weren't available, the only way to build one of the ways to build your portfolios is to have a 3-fund or 5-fund ETF portfolio, right? And I think the Canadian couch potato, they had these model portfolio people follow, and they were awesome. They were great, but there's always some gotcha with those. Is that I think if I remember the 3-fund or the 5-fund portfolios, the model ETFs, some of them had the US ETF, so you have to convert your Canadian dollars to US dollars. And I think it's like VXUS, which is the Vanguard US total market, and then I think it's like VXIX or something, the Vanguard total market, because there was no similar funds in the Canada ETF space, and you have to rebalance those regularly. And with holding US ETFs, when you rebalance, you have to consider the exchange rate as well. So that makes the math a little bit more complicated. It's not nothing that you can handle. I have built a spreadsheet template on my blog that people could download to help them with that. But over time, more and more ETFs came in Canada, and then these all-in-ones become quite popular because they're simple. And I think if you were to pick one, now if you are okay with rebalancing and you want to get into the nitty-gritty stuff, I think having 3 or 5 fund portfolio, you want to go down the ETF route, that's totally fine as long as you're comfortable with rebalancing and you're savvy enough to do that. But if you're lazy like myself, you have lots of stuff to do, you're busy, stick with one of these all-in-ones. It's very, very simple and straightforward. You don't have to rebalance yourself. You're paying a little bit extra in terms of MER, but let's be honest, it's not crazy amount of money. In the day, you're saving a lot of time by not having to deal with the currency exchange, the tax consequences, and also rebalancing. So I would personally stick with one of these all-in-ones. Now, the biggest gotcha, I'm seeing that a lot with my blog readers and also my coaching clients, is that quite often people end up holding multiple of these all-in-ones. Somebody may hold something in the VBAL, which is the Vanguard Balanced ETF portfolio, which is 40% fixed income, 60% equities. And then they may hold, a little bit of VQT, which is 100% in equities. And then they hold some in VGROW, which is 20% fixed income, 80% equities. And when I looked at the portfolio composition, I'm getting a little bit confused. I'm like, well, what's your strategy? Did you want to hold 60-40 or do you want to hold 100% equities? And they're like, oh, I thought by holding 03, that makes my portfolio well diversified. And I'm like, no, you're kind of mixing up the strategy a little bit here. And then the other danger is, you could hold VQT and then you end up holding S&P 500 index fund as well. And you're kind of overlapping a bit because VQT already invests in some portion of the S&P 500. And by holding S&P 500 ETF on your own or separately, you're increasing your exposure to the S&P 500. So you need to watch out a little bit, like in terms of which funds you hold and whether you're overlapping a bit or not. That's where it gets overcomplicating. ETF is not a good thing because you end up holding overlapping assets, and that makes it very confusing when you're trying to figure out what your mix is.
When you have a diversified portfolio of individual stocks, I think it's easy to, you've got 30, 35, 40. It's easy to add one or two and think that you're getting more diversified. And even at that point, you're really not getting a lot more of the benefits to diversification there. So when you're doing the same thing for ETFs, when you're taking a portfolio that is already incredibly diversified, and then you're just adding, like Bob, you explained, just sort of the same product on top of it, and creating that more diversification that way, you're just not doing it. You're just creating complexity for the sake of complexity. It's not giving you any benefit. So I'd really encourage anyone listening who is doing that, just embrace something really simple, but at the same time, don't take unnecessary tax, don't pay unnecessary taxes to do so. I wanted to ask you, Bob, about the S&P 500 ETFs. Is a very popular choice for a lot of Canadians, and the QQQ, the NASDAQ 100 ETF as well. Very popular, I think, with our listeners. What do you think about currency hedging for these products? So pretty much every fund family has an S&P 500 ETF, a NASDAQ 100 ETF, and then a Canadian hedged version of both of those. So the Canadian hedged version, of course, takes out the increase or decrease in the US dollar for your return. So you get your returns just strictly based on the Canadian dollar side of it. My philosophy with these is that you don't want to hedge out the currency because the currency is part of the diversification process. You're not only diversifying into 500 different American names, you want to diversify into the US dollar, because if those companies do well, the US dollar should do well, which should add to your returns in Canadian dollars. So I view it as kind of this extra level of diversification that is actually useful. What do you think about those?
Yeah, I'm kind of in the same line as you, Nelson. I think hedging makes sense only if you're investing in a very short time frame. So by hedging, you're kind of protecting yourself from the big swings of currency exchange. But if you're investing over the long term, and I think every investor should be investing over the long term, is that then hedging doesn't really help you. I think I would lean what you suggested, like not hedging actually improve your diversification and probably help you with the return over time. So yeah, so like for example, we don't invest in any of the hedging ETFs. Like we invest in QQQM, which is another version of QQQ, is a little bit lower MER. Yeah, I think hedging it's a tricky thing because you end up paying a little bit more fees through the ETFs, and I don't think you really gain much over the long term. Now, talking about the S&P 500 and the NASDAQ 100, which is the S&P 500, I guess is VOO, which is the popular US ETF that invests in the S&P 500. And then QQQ is the Invesco NASDAQ 100. Now, those are in US dollars. So obviously for you to invest in these ETFs, you have to convert Canadian to US. So you're up against the currency exchange, first of all. So that's something to consider. Now, if you do want to avoid the exchange rate, there are Canadian equivalents of VOO and QQQ. There are lots. So you could invest that way, just invest in a Canadian version of VOO and QQQ to avoid having to exchange the currency yourself. For us, we converted a bunch Canadian to US a long time ago. So we have some US dollars sitting in our account, and that's the money we've been using to invest in these US ETFs. But if I were to start today, I probably would avoid converting over to US dollars just to make things simpler. But I think either way works. Just you kind of have to make a decision and stick with it. Nelson, what are your thoughts?
Yeah, I tend to agree with what you're saying there about just find the Canadian versions of these ETFs. Make sure that you're buying the unhedged version, so you're getting that US dollar tailwind. If it has been a tailwind for the last decade, will it be a tailwind for the next decade? Who knows? But I think that you want that diversification into US dollars as well as your diversification into the US equities as well. Now, saying that, I think that there are probably some people out there who have 100% of their portfolio in these products in the US market. And I think that's tricky when you're looking to retire inside of Canada. Basically, if you're making a giant bet on the United States as a Canadian, there is a chance that bet will not work out. There's also a chance that bet will work out horrifically well, and you'll just be laughing all the way to the bank. But it's always tricky when you make a bet on another country like that. So I would be cautious if my portfolio was all in one of those ETFs. I would want some Canadian exposure, assuming that I plan to retire in Canada or plan to live in Canada. Bob, let me ask you about there are various cash or near cash ETFs out there, whether it's short-term bonds, whether it's money market. I think the cash.to ETF was popular among people who are just looking for a place to park cash and getting a decent yield. It used to be, I think it was over 5% you could get at one point when rates had kind of spiked up to the top. I think now you're at about 2.5%, 2.75%, which isn't really that exciting. Do you put any of your spare cash in ETFs, whether it's like an emergency fund, whether it's anything like that? Or is that something you just keep in the bank and sort of just play it that way?
Yeah, I think you're talking about the Canadian high yield, high interest savings account, like ETFs. So it's like
Yes,
HISA
correct.
ETFs, or some of them are like cash alternate ETFs, right? So it's like they have symbol of cash, as like you mentioned. I think some are like HSAV or PSA. Yeah, that's a very good question, Nelson. We're kind of in the camp of we want our money working hard for us, and the way for us to do that is invest most of our money in equities, meaning nearly 100% in stocks, either through individual stocks or ETFs, right? So we do have some cash sitting on the side in like high savings account or checking account, or actually checkings account is, always keep at the minimum amount, so we're not paying the monthly fees. But yeah, we have some cash saved aside on high savings account, not GICs. I generally don't believe GICs because you're locking yourself up by a year or two or whatever the term is, right? And you can't really touch the money while you're in this GIC. Now, these HISA ETF, they're a little bit more liquid than GIC. You could trade them just like ETFs, and they provide a little bit higher yield than GICs and such. But over time, as the interest rate dropped, their yields have come down quite a bit. And I, generally speaking, again, we don't invest in those because we think our money would work harder for us in the stock market. Now, if you have money that you want to save for short term spending, maybe these ETFs are okay to invest in. I think the rule of thumb is that you don't want to invest in the stock market with money you need for the next 5 years. Because what you don't want to do is having to sell when the market's down. So if you need some liquidity, either keep your money in the bank via the high savings account, or one of these HISA ETFs is okay. Otherwise, if you don't need any money for the next 5 years or longer, then definitely put your money in either indexed ETF or individual stocks. Nelson, what about you? Do you use any of these ETFs?
I utilize them probably a lot more than you do. So my situation is that I like to keep anywhere from 6 to 12 months worth of spending in cash. And I do that because if the what ever hits the fan and my, the market crashes or dividends get cut or whatever, I have that wiggle room of, I can afford to eat for a while before I have to worry about collecting some cut dividends. Basically, it's a extreme form of an emergency fund. And I, when I was more pushing towards, I was more in your spot, Bob. I didn't have much of an emergency fund. My strategy was, hey, I have credit cards. I have a, home equity I can borrow against. I'm okay if a sort of a job loss happens, because at the end of the day, a big emergency fund really is only guarding against that. The rest of the things that happen, whether it's medical, whether it's whatever, generally you can sell some investments, you can move some money around, whatever, to kind of deal with that. So now, saying that, so what do I do with my cash? Well, for a while, I was using the cash ETF. So that's cash.to in Toronto. It was paying me, I think 5.5%. And I was happy. I was getting a pretty decent kind of monthly income from that while I had my cash in there just in case. But the rate has come down. So what I've started doing lately is, rather than using that ETF, I've looked a little bit at money market ETFs, which are a little bit higher. I think as we're speaking right now, they yield sort of in the 3 to 3.25, maybe 3.5 range. And they do that by buying short-term corporate bonds as along with the government bonds that they buy. So they can get a little bit more yield doing it that way. It's not quite the same. It's not a cash equivalent, but short-term bonds are pretty close. So I would feel comfortable doing that. But what I found success in, and this is kind of getting away from the ETF, the topic that we're talking about, is chasing high interest savings account promos. So what I do is my wife does this. She's the more organized one, but she has accounts in pretty much every bank of consequence that offers these kind of promotions anyway in Canada. The emails come into her and they say, hey, for the next 6 months, we'll give you 4.5% annualized, sometimes 5% annualized on our money. Hey, perfect. That's where that money goes. And it sits there and it collects sort of as much interest as it can. And then once the promotion is done, then we move it to a different high interest savings account. And this isn't a lot of money, but it's a fun kind of challenge. And it's just, if you can get a little bit more from your cash, then that's a little bit more money than what you had before. So that's what we do in terms of that.
Yeah, that makes sense. And I think it's also you're at a different stage than us, right? You're already retired and you're kind of need to do a little bit more protection in terms of the YS, right? Whereas for us, I'm still working full time, so there's that paycheck every 2 weeks. So we're a little bit at a little bit different stage now. If we were retired fully like you, and we need to safeguard that cash, that we'll probably end up doing something similar as you are doing today. Definitely having a little bit more cash sitting on the side and try to earn a little bit more interest with that cash, and sort of dialing different levers to protect us from the rainy days if there's any, right? So there are different strategies, and we're kind of divergent from the overcomplicating ETFs portfolio idea a little bit. Why don't we try to wrap up, unless you have something else to add, Nelson?
I just wanted to kind of reiterate what we've talked about in terms of these ETFs and just how anyone listening, just make the whole exercise as simple as possible. And there are going to be various forces out there that are going to try to convince you to make them more complicated. I'm thinking of Wealthsimple. I use Wealthsimple. It's a wonderful product, but they're managed portfolios, and yeah, they're doing the work for you. So there's a bit of a difference there. You're not building the portfolio yourself, but there are multiple ETFs in these portfolios that I feel are just, it's needlessly complicated because the portfolio manager wants to show you, the client, that they are creating value, that they're helping you to be a better investor by investing in 10 ETFs when 2 or 3 or even 1 would do, depending on your risk factor. So just keep it as simple as possible. Figure out sort of what your goals are, what you want. And I think for most people listening, it's going to be, I want a portfolio that gives me that diversification inside Canada, inside the United States, inside the rest of the world, and just go from there and figure out that it's the steady contributions, and it's the investing in something over 20, 30, 40 years that's really, really going to make it for you. It's not figuring out which of the XEQT, VEQT, ZEQT, TEQT, whatever other EQT, blah, blah, blah. The point is not the ETF itself. The point is a simple strategy that you can repeat over and over and over again for 40 years. That'll make you wealthy. What won't make you wealthy is switching out or making it too complicated or having a million different ETFs or anything like that. Just simple is best, and just focus on execution.
Yeah, I just wanted to add that, again, simplicity is the key here. The more you touch, and I think there's a saying like, your investment is like a bar of soap. The more you touch, the smaller it gets. So the simpler you could have with your investment, the better. And overcomplicating things it won't help you in the long run. So that's the key here.
Yeah, it especially won't help you if you're doing ETFs. Just keep it simple. I think that's about it for this week, Bob. It's always a pleasure to chat, and I guess we'll do it again next week.
Sounds good. Have a good one, everybody.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.